All right, let's get straight to the point. REITs versus investing in actual homes in Toronto. Here's the reality. REITs are perfect for people who want exposure to real estate with minimal effort. You buy, hold, and collect dividends. It's passive, it's easy, and you can sell your shares whenever you want, but the returns really don't compare to investing in actual homes in Toronto. In this video, we'll dive into the differences and returns between REITs and investing in actual Toronto homes. But before we do, don't forget, if you find this video helpful, hit that like button, subscribe for more Toronto real estate investing tips, and if you want to chat one-on-one, you can always book a call with us. Publicly listed Canadian REITs are companies that own and manage real estate, and you can invest in them by buying shares in the public market. They have a low barrier to entry, meaning that you don't need much money to get started. You don't need a high income to qualify for a mortgage, and you also do not need to worry about managing tenants, repairs, or anything else. They pay out rental income as dividends, and hopefully the value of your shares go up over time, so you also benefit from capital gains too. Plus, you can easily cash out whenever you want. And because you don't need much money up front, you can diversify better, investing in various real estate markets or across different asset classes too. However, your returns are typically lower compared to investing in actual real estate because REITs often get lower commercial loan ratios, higher commercial borrowing rates, and huge management fees that eat into the returns you get. Plus, dividends are taxed as income, so you end up with less in your pocket at the end of each year. Historically, over the past 10 years, publicly traded Canadian REITs generate around 5 to 10% in annual returns. Now, let's talk about actual homes, specifically investing in Toronto real estate. When you buy property, you have full control. You decide on renovations, the tenants, the rents, you get steady rental income to offset your costs, solid long-term growth in Toronto's residential real estate market, and there are also tax benefits. You can write off mortgage interest, expenses, and even defer rental income until you sell if you depreciate your building cost each year. But of course, there are downsides. Buying property in Toronto requires a lot of capital, and you're on the hook if your rents don't cover your costs. There's also a lot more hands-on work. Managing tenants in a home can be time-consuming. Plus, it's not a liquid investment. If you want to cash out, you'll have to sell, and that takes time and comes with high fees too. But to help you better understand how the returns stack up, let's look at an actual example. Let's say you put $50,000 into a Canadian real estate REIT. Just a reminder, this is not investing or tax advice, but for educational purposes only. Historically, you're looking at a 3 to 4% dividend return taxed as income each year. On top of that, you might get 2 to 6% in capital gains, and so you're looking at an annual return somewhere between 5 to 10%. Now, let's shift gears and talk about actual Toronto real estate, specifically condos first, which require a minimum investment of $100,000. And you need an annual income of $100,000 as well to qualify for a mortgage. The reality is that the condo market is very weak in Toronto now, and so we're going to use a conservative appreciation rate of 2% a year in line with inflation, assuming a 5-year time horizon, even though historically appreciation has been much higher in Toronto condos, around 7%. On the other hand, we're actually seeing better rent yields these days because of the softer market. With that $100K of capital, you can buy a condo around $450,000, which gives you actually a bit of positive cash flow in year one. Add that to your principal pay down and appreciation, and the first year ROI gets close to 16%. Keep in mind, you can also defer rental income tax if you use depreciation, which means more money in your pocket each year. Already, this is much better than the REIT. Now, if we bump things up to a multiplex project in Toronto, which realistically requires a lot more money because you're paying a higher purchase price and you need to put in renovations out of pocket, but then you could see much better cash flow, which bumps up your annual returns. And also, let's say the value of your home goes up by $150,000 as well because of the renovations. And that means you can tack on an extra 8% annually over 5 years as well. All in all, you could be looking at a 26% annual ROI over a 5-year horizon, and that is huge compared to REITs. So here is where we're at. REITs are easier, but the returns can be much better when you invest in actual property in Toronto. At the same time, actual property is not for everyone. It does require a lot more work, it's a bigger investment, and there is more risk. But at the end of the day, it's your money, your choice. Just make sure you know the facts so that you can make better decisions. And if you want to dive deeper into what makes the best real estate investment home purchases for you, let's chat. We're not just another real estate sales brokerage. We're experienced real estate investors in Toronto, especially when it comes to multiplexes. Whether you want to buy a property that's ready to rent out or you can convert one into multiple units, we can help. Here's what it's like to work with us. We'll take the time to understand your goals, help you find great investment opportunities using numbers, and eventually help you buy the option that fits you best. Need renovations? We can connect you to trusted contractors as you manage your project, and we'll be around to coach you too. Once it's done, we can lease and manage your property as well. Ready to get started? Just head over to this link here and let's chat.